Gold just ripped through the one floor nobody thought would break today. And right now at 4,540, we are standing on the edge of an acceleration towards 4,500. But here's what makes this dangerous. The trap is already set, and most retail traders are about to walk right into it. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end, because I'm giving out 3 exact entry and exit levels you can use right now. And the last one is for those who understand that big money is made when panic spikes. Write this number down immediately. The market bias for gold today is a trending, strong sell across all meaningful time frames. The one invalidation level that proves this entire bearish thesis wrong is a daily close back above 4,596. If we close above 4,596 on the daily candle, the structure shifts, the sellers lose control, and we could see a violent short squeeze. But as long as we are below 4,596, every pop is a selling opportunity. Right now, gold is trading at 4,540, having already sliced through the critical support at 4,549. That number, 4,549, was the floor for the last 3 sessions, and its break has unleashed fresh momentum. The next magnet is the psychological 4,500 level, and below that, it gets very thin air. So write it down. 4,596 is the invalidation point. If you remember only one level today, make it that one. Now let's pull up the charts from the top down, because the weekly and daily timeframes are telling a story that most people are ignoring. On the weekly chart, gold has been carving out a massive distribution pattern since failing at the 4,800 zone. The 200-week moving average is still far below, but the 20-week and 60-week averages are starting to roll over. Price is now below both, and this week's candle is shaping up to be a Maribozu-like bearish engulfing. This is exactly what gold's worst week in nearly 2 months looks like on a higher time frame. The weekly MACD has a fresh sell signal, with the signal line crossing below the histogram, and we are seeing increasing bearish momentum drop down to the daily chart, and the picture gets even clearer. The 200-day moving average is sitting up at 4,750, acting like a brick wall that price hasn't touched in weeks. The 60-day moving average is at 4,680, sloping sharply lower. The 20-day moving average is at 4,620, and price has been hugging below it like a ceiling. Every bounce towards the 20-day MA over the last week got sold hard. Today, we are trading well below all these averages, confirming a strong sell regime. The daily support at 4,596, which held 3 times before, got obliterated overnight, and then the 4,549 level gave way in the Asian session. That 4,549 is now resistance. Not just any resistance, it's the old support turned new resistance. The daily MACD is in negative territory and expanding, with no sign of bullish divergence. We have a clear lower high at 4,700 and lower low now at 4,540. This is textbook downtrend. Acceleration. Now let's drill into the 4-hour and 60-minute charts, because this is where the setup is razor sharp. On the 4H, the moving average alignment is perfectly bearish. The 4H 20-period MA is at 4,560 and falling. The 60-period MA is at 4,595. Right around that crucial invalidation zone, and the 200-period MA is at 4,650. Price has been consistently rejecting the 20 MA on every pullback, and the most recent touch was a kiss and drop at 4,570. The 4H MACD histogram is printing deeper negative bars, and there was a glaring negative divergence that formed 2 days ago when price made a small bounce but momentum failed to confirm. That divergence is now playing out exactly as it warned. On the 60-minute chart, we are seeing a series of lower highs at 4,590, 4,570, and now price is breaking to fresh lows. The 60-minute 200-period MA is at 4,620, far above, so the short-term trend is purely momentum-driven. The key resistance to watch on a bounce is the 4,549 area, which is the broken support and also aligns with the 60-minute 20 MA. Any retest of that level that fails will be a gift for sellers. The next support cluster below us is 4,500, which is a big psychological number, and then 4,470, which is a previous structure low from 2 months ago. I'll use those numbers later in the strategies. Here's what most traders miss when they look only at gold. The cross-asset linkages are screaming the same message. The US dollar index is surging to new weekly highs, and when the dollar rips, gold pays the price. I'm watching euro to US dollar and pound sterling to US dollar both breaking below key supports, which confirms broad-based dollar strength. That's not a coincidence. It's a macro dollar bid fueled by rate hike bets. When the euro and cable are falling, gold's inverse correlation amplifies the move. And then we have real yields. The 10-year TIPS yield has broken above 2%, which is a death sentence for a non-yielding asset like gold. The opportunity cost of holding gold just got more expensive, and that's why we are seeing this relentless selling. Even oil, the geopolitical heartbeat, is not spiking to offer an inflation hedge bid. Crude is relatively contained, so there's no safe haven demand stemming from energy supply shocks. Bitcoin and the S&P 500 are still in risk-on mode, but gold is not benefiting from that risk appetite because the rate differential is the dominant narrative. Gold is the fear architect, but right now there is no fear, just a hawkish Fed and a dollar on a rampage. That's the fundamental web that supports the bearish lean for the next 1 to 2 weeks. The event that would invalidate this thesis entirely is a sudden dovish pivot in FOMC minutes next week or a geopolitical shock, but right now the path of least resistance is down. Yesterday's core news cemented this. Multiple Fed speakers reaffirmed that rates will stay higher for longer, and the market is now pricing in less than a 20% chance of a cut in the next meeting. Gold is set for its worst week in nearly 2 months, and the final blow came from stronger than expected US services data that sent yields higher. That's the fundamental driver you need to tattoo on your trading plan for today. The dollar isn't just strong, it's accelerating, and gold is the mirror image of that move. Most people will skip this next part, but this is where money is made. Keep watching, because I'm about to lay out 3 precise trade setups with exact entries, stops, and targets. No theory, just levels you can place right now. Strategy 1, the sniper, the conservative approach. This is for the patient trader who waits for the market to prove itself before pulling the trigger. The trigger condition is a pullback to the freshly broken support-turned-resistance zone of 4,549 to 4,555. We need price to come up, tap that zone, and then show a clear rejection on the 15-minute chart, ideally a bearish engulfing candle or a shooting star. Entry on the break of the rejection candle's low, so that's a sell at around 4,550. Stop loss goes at 4,565, which is just above the 4H20 MA and above the consolidation area that formed before the drop. That's 15 points of risk. Target 1 is 4,520, giving a risk-reward of about 1 to 2. Target 2 is 4,500, bringing the total risk-reward to 1 to 3.3. What voids this setup? If price breaks and closes above 4,596 on a higher time frame, the bearish structure is broken, so you exit immediately. Also, if we see a sudden safe haven headline that spikes gold through that resistance, you stay out. This sniper entry waits for that perfect retest, so you might not get filled today. That's fine. Discipline is the edge. Now let's see how aligned we are. Type your gold range for tomorrow's session in the comments right now. Just give me a high and a low. I'm reading them, and I'll highlight the most accurate ones in tomorrow's video. Strategy 2, the active trader, the standard setup for those already in the flow. This one uses a breakdown entry on the intraday momentum. Here's the plan. If gold continues to crack lower and takes out the Asian session low of 4,535, that's your trigger. Entry is a sell stop at 4,534, or market if we get a clean break and hold below it. Stop loss is at 4,550, right above the 4,549 resistance level. That's a 16-point risk. The reasoning is simple. A break of 4,535 confirms bearish continuation, and 4,549 is now solid resistance that if breached, negates the immediate downside momentum. Target 1 is 4,500, a major psychological magnet where we'll likely see some profit taking. That's a 34-point reward, giving a risk reward of over 1 to 2. Target 2 is 4,470, the next structural support that lines up with a previous swing low. Once target 1 is hit, I want you to move your stop to break even and then trail it by the 15-minute 10-period moving average to lock in any further extension. This setup has a higher probability of getting triggered today given the current velocity. If price instead bounces first and stalls below 4,549. You can also enter on the rejection with the same stop and targets. Adapt the sniper mentality. Strategy 3, the aggressor, high risk, only for those who know how to lose small and manage risk aggressively. The aggressor goes in now, at market, taking a short at 4,540, riding the momentum without waiting for a pullback. Stop loss is at 4,550, just above the broken support. That's a 10-point stop. Tight, because if gold reverses that hard and fast, you want out immediately. Target 1 is 4,500, a 40-point gain, which gives a massive 1 to 4 risk-reward ratio. Target 2 is 4,470. This is a momentum chase on the 5-minute and 1-minute extreme overshoot. The clear invalidation is a move above 4,550. If we see that, the trap has sprung, and you cut it, no questions asked. Explicit warning: this strategy can get you chopped if the market decides to make a V-shaped recovery. Only enter if you are prepared to accept a stop out with zero hesitation. Do not size too big. This is a scalp on the back of institutional flow. 1 sentence risk management pulse. Never risk more than 1 to 2% per trade. Do not hold through high impact news like FOMC minutes, and stops are non-negotiable. Here's the single most critical level for the next session, 4,596. As long as gold stays below it, the bears are in full control and every rally is a sale. A daily close above 4,596 changes everything, so monitor it like a hawk. Tomorrow, we are going to drill into the US dollar index and the S&P 500 divergence, because that liquidity tide is setting up a massive move. Gold will react to that, so make sure you're here. If you want the full breakdown on Bitcoin and the S&P risk asset shadow, that video is live right now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage on all 8 key assets. I'll see you in the next one.